This is a Momentum Media production.
Inside Commercial Property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
Hi everyone, how you going? Phil Tarrant, co-host Inside Commercial Property, recording in the studio. We're back in business after the fatigue that was Zoom and COVID-19 when we launched this great podcast, now the most popular commercial property podcast in Australia, which is pretty cool accolade to have. We didn't think it would be that when we set out producing it. The idea was just to help Australian commercial investors better understand how to go about effectively investing in commercial property rather than residential property, but seems to have resonated, which is good. Probably not me. There's a reason why. It's probably my co-host Scott O'Neill, who's the founder director at Rethink Investing, is the guy behind this idea, and I'm just sort of carrying him along part of the way. Scott, how you going, mate? You well?
Yeah, very good, mate. Very good.
It's good. So we last time we got together pre-election, we spoke about some of the feedback that we've been getting, which was pretty good, and the fact that we sort of were concentrating a fair bit on the economy and what's going on and how it's all shaping things, and and rightfully, all those issues, wider macro, microeconomic factors which are shaping the way in which Aussies are conducting business, inflation, supply chain challenges, et al., all that sort of stuff. And we come to the conclusion, Scott, that it was right for us to talk about this stuff because commercial property is essentially the property that businesses operate within. So therefore, commercial property is intrinsically connected with business health and business sentiment, which is intrinsically connected with the economy. So we had that discussion last week, which is good, and we asked for more feedback. And I'd like to thank all those people who have been providing feedback to us. And universally, one of the current or common themes is more case study type stuff, Scott, is what people want. Jamie, in particular, and Jamie, just shout out to you, mate. Thanks for writing in to Scott. We do appreciate the feedback. It helps us really help shape our discussions every month and how we can best serve the community of property investors, commercial property investors out there. And he wrote quite a long note, Jamie, thank you. But he's spoken about wants customer testimonial of purchasing process where they bought. Sort of examples take up the whole episode will be really good. Negotiation examples, I had to negotiate, and examples of that. Case examples of clients 2, 3, 5 years after purchase, issues they've encountered. That's really good stuff. Lease renegotiation or loss of tenant migration. That's really important stuff. Maybe specific episodes with more financial detail. And he speaks to your book about that that you wrote, which has a lot of info around it. Interviewing a commercial sales agent, I think that'd be really good. See if they can uncover all their secrets, their tricks that they make it hard for us to deal with them. But it's really good feedback, and thanks, Jamie. So you've given us some really good topics there to help shape the coming series of Inside Commercial Property. But one of the purposes, and we spoke about this a couple of podcasts ago, of me buying a commercial property with your team over at Rethink Investing was to actually have a really good real-life case study that we knew was actual. I knew about it because I was actually buying through it. And we sort of set the goal to secure a commercial asset, which I'm buying inside of my super fund. And my brief to you and your team was, let's buy something that is pretty much what most people would be buying. So it's as relevant an example as possible. And I sort of gave you guys a budget about $1 million to about $1.2 million, I think, by memory, which was sort of a classic sort of place where people would be buying, i.e. sort of 400 odd grand in super that you can channel into the purchase. And we've gone through a bit of a hit and miss. We've been looking at different markets right across Australia. And the last time we got together, we spoke about how the next time that we spoke, we give some more details on that purchase. And I'm happy to report that today will be a podcast where we speak specifically about that. And for some of those who know me, know I've been out on the road the last month or so right across Australia presenting to mortgage brokers looking at the mortgage market and the interconnected real estate sector. Well, those people that saw me in the plane saw me flying out to Perth recently to speak at the Better Business Summit. And yes, I was in Perth to speak at that large event, but I was also in Perth to look at a property, which was a secondary consideration, but the timing was perfect. So I've just given away where I am securing a property inside of my super fund. It is in Perth, and this podcast today will go into some details around that. But Scott, some places we missed off before we got there.
Yeah, so we'll go through the process. I'm looking back at when you signed up, which it looks like it was in December. So December, the brief was, like you said, 1.2. There was a bit of a flex in that, as you mentioned. So straight away we started looking. I think I sent you a property about 2 or 3 weeks after. This one was in the Newcastle region. It was like an industrial showroom type property. It was 1.25 mil. Decent property. We're looking at a yield of, it was 5.52, which is not bad for that area. You passed on that area, I think mostly just because of your stamp duty implications in New South Wales. You already had a fair few objects or properties in that market. So we looked at that one, passed on it, first property. I always find that clients like to look at more than one property anyway. So you need context behind your decision. So the next property I sent you was one you actually liked, and we tried to get this one. It was up in the Trade Coast of Brisbane. Very similar yield in the mid-5s, but like blue chip market. It was a warehouse office combination. It had a 3-year lease on it. Nice, attractive looking property, 1.45 mil. And we tried to get it, but as this was an off-market deal, but the agent basically sent it to one other person off-market and they paid cash for it at a higher price. So we got blown out of the water there. Then we moved on to another one. So this is about a month later. This one was more expensive. It was a 1.98 mil one. It was like a chemist warehouse arrangement. And I think we were just pushing the budget a little bit too far for the initial brief. But, it was a chemist warehouse. It had 4% increases in it. Blue chip tenant, just under a 6% yield, like very good proposition, but it was nearly $2 million. So I was stretching the brief basically. And then after that, we looked at a Townsville asset. This is a freehold one, industrial 5-year lease. It was like a well-known card smash repair type. So it was a bit of a more dirty tenant, but like it was a big freehold parcel. So we're looking at a 7% yield on this one, older building. But that wasn't really floating your boat. I think you like the idea of something more low maintenance because it's your super fund. And that one had quite a large building on it. It was sitting over 2 titles as well. Sometimes multiple titles can cause problems with super funds because you got to, they like single dwelling, it's just got to be on single titles. Otherwise, you might be up for extra cost. And then we landed on the deal you ended up proceeding with, which was in Perth. So, this one was like in a front row position in a complex, and it was a mid 6% net yield, and it was a really clean property. And
it was super clean and a nice bit of, importantly, also some diversification. This is inside my super, and I don't really have a lot of exposure over in Perth, so it was good to get into that market. And everyone's been looking at Perth for ages, and the commercial market there is hot at the moment. The good thing is that fortunately I had to be in Perth at a very similar time to when this deal was coming to a conclusion. So, heading out and checking out the property. To be fair, though, I was there for like 5 minutes, right? And I just went, yep, it looks like the pictures. Not a lot, really. It's very, very different to resi, and therein is like, some of the difference with the commercial property. But top line, this particular asset, and we look at sort of going back to asset selection, we'd filtered down looking at industrial over retail or office space as part of the brief. So we didn't even look at any of those stuff. We said, look, let's get good mid-market, industrial, warehousing type, new economy type sort of assets where a big need for the type of storage and good areas where there is a need for those sort of trades-based type stuff. So that's what we went with. This particular asset, it's in the city of Swan. For those that know, I'm not going to tell you exactly where it is, but it's in the city of Swan, about 20 minutes from the airport, smack bang in the middle of major arterial road junction. Zoning is industrial. Land area, Scott, 763 square metres. Net lettable area is 603 square metres. The tenant in there, there's sort of a trades-based goods and materials, so they service the electrical trade. Lease term there, Scott, 3 years, 3 months and 7 days at the time of the due diligence. It's got a WALE, W-A-L-E, 3.278. Most people are going to go, what's that?
Weighted average lease expiry. So it's probably more of a relevant comment when you've got multiple leases. So imagine you've got 3 years of leases and there's 3 of them and they're all on 3-year leases. They average out at 3. But if you got one at 10 years and one at 0 years, your average WALE is 5 over it. So Yeah, it's effectively telling you the lease term left in the lease.
Yep.
On
That's
this one.
a good way to view it. Car parking, he's got 12 on-site car parks per the title. Outgoings, about 18 grand a year. Purchase price, $1,050,000. Net income, Scott, and this was quite attractive, 70 grand. Annual reviews on CPI. Options on the lease, 2 times 3 year options, and a net yield, and this is the attractive number, it's 6.67%.
Yeah, and it was one of the separating factors with a couple of the other ones. We're finding Perth, it's a little bit earlier on in the growth cycle. So you're getting the yields you were getting in Brisbane 2 years ago. The yields are compressing very quick, so I expect this to have quite a lot of capital growth for you. A lot more than you'll think too, because they're already starting to sell similar assets like this into the mid-5 net yields, which means people are paying more for that same rent value. So people are seeing value. The CPI in Perth is through the roof at the moment, so you're going to get about a 6% rise in your rent next annual review. So yeah, the rents are going to go up quite quickly. There's going to be compression on it. Anyone who thinks there's no capital growth in commercial property just needs to talk to you on this asset in a few years' time. And you're going to see some very good results.
And we'll talk about some of the strategy around it. So to get some sense for it, just imagine a smaller industrial complex. I think there's about 20 different places inside of this asset in an industrial, a very established industrial area of Perth, really good access to all the roads in and out of it. Everything is there. It's a sort of modern industrial high bay industrial warehouse. So it's got like a little showroom. It's got an office section. Then it's got all the factory bit out the back where everything is stored with, forklifts driving around and boxes and shelves and everything everywhere. And there's an upstairs mezzanine type office areas, a couple of toilets there. There's kitchen. There's all the usual stuff. Imagine any industrial complex anywhere in Australia, it looks exactly like that. There's currently leased out to 2025, options based on those things set in the lease to 2031, which is pretty cool if you can keep that sort of CPI increases if CPI continues to go. The company that's in there supplies resi and commercial customers across Australia and New Zealand since 1988, so it's been around quite a long time, this particular company who's in there. The warehouse is clear span, high truss, accessible via a large roller door, and office space over 2 floors. So heaps of natural light, really good street exposure. It's the front of a range of commercial assets along there in this area, which has like manufacturing, direct sales, logistics, e-commerce, and storage. So it is the front one. It looks good. It's got big windows. It's large. It's well designed. It's within a sort of core northern industrial market of this part of Perth, 12 kilometres from the Perth CBD. So if anyone knows, I reckon you get some sleuths out there. We'll probably go and try and work out where that is. If you do, you can email Scott. Tell us where it is. 70 k's from the airport. Major roads, Reed Highway, Mitchell Freeway and Tonkin Highway. So let's see if anyone can work out where it is. And if there is, Scott will buy you a steak dinner. There you go.
Jeez.
Yeah.
A lot of listeners, mate. Yeah. Going to be a busy month ahead.
Yeah, no. So the tenant looks good, and interestingly, this is a leaseback. So they currently own the property. Let's have a chat about that. What does that mean?
So leasebacks are a common purchase for us. So there's sometimes red flags with leasebacks because everyone worries, why is the tenant selling or the owner? A lot of this reason is, I'll read it because this is part of the due diligence report we said. In red, it says, why is he selling? Seller who also occupies the property are looking to release capital for the sale, but they have put the lease in place to protect the ongoing operations of the business. There's multiple directors in this. One of the directors wants his money, effectively, and they're just splitting affairs to a degree, but the business remains a commodity that needs to keep going ahead. And leasebacks are only risky, in my opinion, if you think they're selling because their business is going down quickly or the rent is well inflated, which leads me on to the next part of our due diligence, which is checking the rental comparables. So page 8 of this report we sent you, it's got an average, the average square metre rate for this property is 116 a square metre, which is quite low for industrial properties nationally for this type of stuff. This would rent for probably a 150 a square metre in Brisbane, Sydney, a little bit higher, Melbourne, similar to Sydney, it could be sort of 180, that for this size. Even in regional cities, it can be in the mid 100s. So 116 a square metre passes the comparables test from a national point of view, which makes me think there's value in Perth.
So you're
long-term.
saying it's the Perth rents aren't overinflated compared to national averages, and this particular asset isn't overinflated, is it?
Correct.
Yeah,
So
okay.
the average rate in Perth for this style of asset's about 120, and that's for much older sheds too. So this one, I would probably place a market rental value about 130, but then there's also upside in the general market as it plays a bit of catch up to the rest of the country, because there's no reason why Perth should be cheaper than regional areas. Stock is quite tight, so you're going to see that catch up factor through, or basically flow through the market over the next few years, in my opinion. And 116 is a good rate. It shows they haven't inflated the rent for the sale. If anything, they've gone unders, which shows they've got long-term vested interest to stay here because they want to pay a fair rent value. So that passed the leaseback test. And yeah, if anything, you've got a nice cashed up tenant as well. So that's the other way to look at it.
So with this, looking at the lease back, and it's a key thing, right? You've got to look at this why. You go, or just ask those cascading questions, why, until you're satisfied as a buyer that you're actually getting the facts that you want. Now, the lease security, though, on this is just like 10 grand, but they haven't given a personal guarantee. Is that something we should be concerned about?
Good question. This comes up quite daily. So everything's negotiable in a lease. So they're putting 10 grand down. The reason why we're not going higher, and we can ask for that, it's just a function of will it crash the deal? Will it really add value to you? If you, let's say, get 3 months of rent extra, like a 3-month bond is pretty standard. That's what you work with. And that, you're not far off that in this case. So I know this market quite well. To release this property, you'd be looking at probably a 2-month period to lease up. So I'm not fearful of you having a very long vacancy because there's simply nothing available like this in the market at that price. If your tenant left, if anything, you'll get more rent and maybe even a longer lease. Like you might lock someone in for a 5-year lease at a higher value. So, there's no real great downside in that. But if you bought a different type of asset, like a large retail shop front or a showroom and that went vacant, you're looking at much longer vacancies. So you'd probably be focusing a lot more on trying to lock in big deposits or, personal guarantees of the sort. But yeah, we're quite confident in this business. You're getting an above average yield for the market. The CPI is a big win as well. That I think if you're going to negotiate, you could trade things for CPIs back to a 3% to get more bonds. Like it's all just a business negotiation at the end of the day.
Yeah. Okay. And I'm sort of satisfied with that. And speaking it's good looking at this report that your team has put together, which is very informative. But for me, it was all about, and it was serendipitous, the fact that I was in Perth. I've been in Perth for some time. So that I could actually get on the ground and have a nose around and speak to the agent. And she was like, you'd move this thing in a heartbeat if you didn't have a tenant in it. There's people lining up for this stuff at the moment. So I don't really have too many concerns about that.
Yeah. And looking at the actual numbers on your property. So we've ended up securing this for 1.05 mil, which was below your budget. Again, one of the other reasons this one was quite attractive, it's just a good dollar for dollar deal. I think you gave me an interest rate of about 4% for your super fund. So we just plugged the numbers in. So assuming you're putting a 30% cash down, plus all the costs, that includes stamp duty, solicitor cost, valuation, like it's going to equate to just under 400K, 395 to be exact, is the cash you'll be putting into this deal at settlement. The loan will do the rest. You're getting 70 grand income on that. So if you minus your mortgage, your 70% mortgage on this, you're going to be clearing a 40,600 net cash flow.
In year one,
which grows to, probably about 45 year 2 with the interest rates and CPIs and all that kind of stuff. So, pretty good return, 800 a week for doing absolutely nothing other than collecting the rent. The tenant pays your management. It pays your strata in this case. There's no building insurance because the strata covers that. So it is a true net return.
And for those of you who are still on the fence of resi versus commercial, this is one of the areas where commercial beats resi in spades is around the cost for holding the properties offset to the actual tenant. Rather, in resi, you got to pay for most things. And the outgoing analysis, outgoings is just a commercial term for what stuff you got to pay as a result of holding commercial property. Council rates, that's about $8,000 a year. Water and waste rates is $2,000. Land tax is $1,100. Body corporate, $2,800. The insurance that Scott mentioned is covered by the body corporate, and then your management fee, you're in for about sort of 5% there. So call that $3,500. So total outgoing, Scott, on this is $20,000, right?
Yeah, and you can see from this table we presented, we go to the decimal point because we actually verify these numbers. And this is what anyone should do when they purchase a commercial property. Actually get statements and check. Do two things. Get the actual invoices and also check the payment history through ledgers, because sometimes the tenant's not paying land tax and they should have been. You need to see proof the tenant's paying, because although the lease mates state that they have to pay land tax, maybe the owner hasn't been pushing that, and that could lead you to it's a management issue, if anything. You're going to basically tell the tenant, sorry, we've got some bad news. You've got to pay this new invoice. And they're going to do it, but it's just going to be a management problem, and you're going to be dealing with a disgruntled tenant. So if you can iron all that out before settlement, it's preferable.
Yeah, it's really handy. You want to sort that stuff out. So $70,000. So the $70,000 a year is essentially just the lettable area times how much it is a square metre equals $70,000. And you sit there thinking, wow, there's $20,000 a cost for holding this property. Well, it's not, because it's all paid by the tenant, right? So the only cost you have in holding this particular asset is the mortgage once you've secured it. There's nothing really else you got to. So when you look at the numbers, you go, oh, that sounds really simple, right? $70,000 in rent, you're paying out $30,000 in interest. So it's not, that's just the interest payment. Leaves you with 40 odd grand, 41 grand, right? Return on equity, so pure cash flow is about 10%, which is not bad going. So what you do is work out, well, what do I do with that $40,000, $41,000 a year? You know, we'll pay the interest off, right?
Yeah.
Be the simplest thing to do.
And obviously 10 years at 40,000, and it grows. Like by year 10, you're actually clearing 88,000. So you can see, you know, you're not collecting 400,000 over 10 years. It's growing on itself it's compounding on itself essentially. So, you know, you might be clearing 550,000 over 10 years, which, you know, that's almost your debt gone. So you could choose to put it back into your debt. And that's a calculation we often run for clients. What's the payback period on the property? For your property here, it's probably about 12 years, the payback period. And it's a pretty handy result if you have a debt-free property in 12 years, and it's probably going to be worth about 1.6 mil in that time as well. So you've got a debt-free 1.6 mil asset clearing nearly 100 grand in about 12 years' time.
Yeah, which is worthwhile, right?
Yeah, and a very low-risk way of getting it as well. Like there's many ways to get 100 grand passive income in property. It's, you know, there's many books written on this, but you can do it with $1 million commercial
one property.
Yeah.
You know, one property.
In 12 years' time.
Yeah. That's pretty cool. So that's what appeals. It's, you know, it doesn't set the world on fire. You don't sit there and go, well, that's retirement money. But it's 100 grand in your pocket.
Yeah. And if you can replicate that a few times over, you're doing very well.
Okay. Yeah. I do like how your team has presented these numbers. 88. So by that point in time with those increases that you've put in there, it's 88 grand in income.
Yep.
Every year. So the net income every year, which can go a long way.
That's right. And sort of the next part of the report, we really just go into things like the easements and, you know, checking there's no deal breakers on the property. So we obviously have reviewed a building and pest report. Your report was very clean. Like I'll read the comments. We had the car park line markings are faded. Not really a big issue. There was some cracked glass. So we've requested the owners to fix that, which they've agreed. There's only 2 items. So expect more items in general with commercial property because you're dealing with big business. You know, this is a 600 square metre building. So that's like the equivalent of 3 houses in size. So to only have 2 little items, you're quite lucky in this case. And yeah, there's a bad building report I actually think is an opportunity unless it's a severe issue, but you can often negotiate, you know, $2 for every $1 you'll need in reality. Like if there's 50 grand damage, you might get 100K off the price. So it's all dependent on the market and the asset and the owner, of course. But, you know, that's what we'll do, negotiate items that must be fixed. But remember, the tenant pays your maintenance as well. So often it's just a notification process for them to sort it out.
What I was going to ask about, Scott, and it's good to pick through the numbers, you had a really good chart as part of this DD around economic trends. You talk about suburb rent growth, dollars per square metre per annum. And this is in this area of Perth, right, which is largely an industrial precinct. From back in 2016, was $110 a square metre. Sort of bottom of the market in 17, it was down to like $98. And then it spiked, and you're probably looking at the same, between 2018 and 2020, it ratcheted up from about $100 a square metre to $170 a square metre. And that was in the back end of the start of 2020, peaked, and then it bottomed out in 5 months' time back to $100 a square metre. You look at that and just got all I'm seeing here is a huge bubble in what is a pretty linear standardised rate for rents. And then it sort of peaked a little bit again in 2021. Then it's sort of come right back again to under $100 a square metre. And it's sort of slowly now on an upwards trajectory moving forward. What happened during that period of time where you got this massive bubble of rents rocketing up to $170 a square metre? Was that like a supply side issue?
Yeah, so my knowledge of it was there was some new releases of smaller, higher value, higher square metre rate industrial properties. So one of the problems with looking at square metre rates through these automatic reports is it's off the back of not much data. So it's suburb related. So it can be easy to be skewed. So it's like when you see a residential suburb with 50% growth. Maybe there's a new house and land package, release go up in a regional town and it shot the values way above the fibro houses in that area. So similar trend with this, but you can definitely see there is an upward trend. But there is that kind of in the middle, like you said, that bubble, which looks completely unnatural versus sort of the long-term patterns. And it's at a time when we weren't seeing rents increase. Perth in 2018-19, there was not much great economic growth happening. It was plateauing at that stage. We've seen the rapid growth really only in the last probably 12 months, maybe 18 months out there. So that market's been quite good through COVID, but seeing an average rate of 170, the only way that you can explain that is just some smaller properties that don't have the economies of scale going from shooting the average rate up above. And basically they've flowed through onto this graph.
So where we are with this right now, all the contracts have been signed and it's all unconditional. So it's booked for settlement. And by the time this podcast goes away, we'll probably be right on settlement. So too late for everyone else. It's goodbye. And you know what's really good? I was sort of walking around the area a bit and having a nose around. It looked really well kept. Like the first thing I remembered is I got pulled up in front of a taxi out the front. It had the best grass on the street. Like it was well cut and looks like someone cared for it. All the hedges were trimmed and there was no litter in the parking areas. It looked really quite neat. Does that matter? Does that give you a sense for how it's managed?
Oh, look, it does for businesses. Like you never really want to place your business in something that looks terrible. It's not as important for residential. If you go into a bad street, it's a long way back to get things to where you need to be. But like it will dictate the types of tenants you get. Like if it has a bit of a corporate-y feel, you'll have more of a professional service type tenant. If it's just a dirty big tin shed, you're going to have all sorts of tenants, which might be equally good at paying your rent. It's just a different type. Mechanics, people that are storing like civil materials, like they'll destroy any grass around because they're probably driving big trucks over it. So it's really, it's tenant dependent, but look, it's always good to have a well-maintained strata building, which is one of the benefits of having a strata, and because it's like a second set of eyes over your property.
Yeah, it is good. This probably all sounds good and we're pressing ahead with it, which is good. Anything curly, anything with hairs on it with this, anything we need to be worried about? Do you think?
Look, the only thing would be probably just the leaseback scenario. Like if it was like you'd always prefer a non-leaseback, but like I said, if we know the reason for it, we've effectively done the due diligence and passed that topic. So the releasability of this is strong. Perth is at a really good time in the cycle to buy, in my opinion. And look, obviously the rising interest rate environment is something that every investor must consider. So factor in higher interest rates if you can deal with that. That's really nothing to do with this property. That's just more being a good investor. So
but you look at worst case scenario of this to hold this property, even if interest rates quadrupled. There's enough fat in there. You'd have to. You wouldn't be able to be paying off the principal component of it, but you could hold this property for quite a long time if interest rates spiked at an interest only level. So the worst case scenario is can you hold this asset in your super fund? I can't see something drastic would have to happen in order to necessitate selling this asset.
Correct. And the commercial market, people forget there's nowhere near as much debt in there as a percentage. Like most people we buy these properties from have like less than 50% debt on them. And the main reasons for that is they've bought it, they've held it for a decade and they've probably had, no debt left on it. So what I'm seeing on the coalface with these interest rate hikes coming is we're seeing less entry-level commercial investors because they're the ones that get spooked generally. We're finding like the amount of leads we're getting through to Rethink's business is actually, it's probably dropped off somewhat, but there's larger clients at the moment because I think there's more people like in your situation, Phil, where you got a lot of residential properties and they're thinking now I've got to fix the cash flow dynamic in my portfolio a little bit more. So that's what I'm seeing. I'm seeing overall less investors, but more experienced investors looking at this and new investors that have never looked at commercial property, which I'm finding very interesting and quite similar to what happened in 2018 when APRA was playing around with the serviceability calculators. It feels very similar to that. And commercial did very well after that period.
Well, we've got a new government now. Anthony Albanese, the new Prime Minister, the Labor Party, which is we've covered quite a lot on smartpropertyinvestment.com and all our other platforms here at Momentum Media. And I note markets are up on the backs of that. There seems to be at least some confidence now. We know what the next 3.5 years look like and who's in power. What does that mean, do you think, for commercial markets? Going back to this fundamental point of commercial markets are intrinsically connected with the economy.
Yeah, well, look, Albanese is saying he's passing the same tax cuts back to business, so small business will do well from that. There's also, he's saying that he's going to work with business to help deliver those efficiencies, to help get pay rises for workers. So look, I think overall this is all good for the types of commercial properties we're buying. Like manufacturing is a focus for this government as well. Like, so, I think no matter what happened with the election, the fact it's over is going to be a better thing because it's back to business and people still have the same retirement goals and there's a solution that commercial property can provide, and it is a higher income asset that you can hold long term and hedge your bets against inflation, which we discussed in that last podcast. So there were no big gotchas in this election for commercial property. So I really can't see anything other than just the whole inflation and supply chain issues, which will sort of weigh on certain businesses being the factor.
Yeah, and I see Peter Dutton is now the new leader of the opposition with the party Prime Minister has chosen not to lead the coalition or Liberal Party anymore. And even he's sort of saying, we need to get back to sort of grassroots business rather than the big business, big end of town. And you need to remember there's only 3,500 large businesses in Australia. So these are companies with more than 200 employees. It's not a lot. It's 50-odd thousand medium-sized businesses. There's like 1 million small and micro businesses. And typically they're the type of organisations and businesses that tenant these sort of properties, right? They're not the big end of town.
Yeah.
And you can see the new Labor government will be, no doubt, I think, really connected in with supporting the SME sector in Australia. So be interesting to see how it all pans out. But for property investors, no real alarms or concerns.
No, other than, like I said, the interest rate scenarios. So like if you factor in, 1.5% rise or, no one knows. Like this is the thing, like economists will inevitably get it wrong. And so you and I have no hope, but we can just go with our gut and play the long-term game. But I see interest rates going up. Let's say it goes up 1.5%. That will have no real material impact on commercial property other than the lowest yielding ones becoming less desirable. So there will be a flight towards yield. You'll see continual growth for those who have got, well-placed assets. And I think it's just understanding the leasing market, which there is a lot of leasing going on right now in 2022. There's a bit of pent-up growth happening. So, yeah, look, I see less downside than I did a year ago at the moment.
And the magic number here for this property is that net yield, which is 6.67, right?
Yeah.
And so what that's essentially the free cash flow you get each year on this over the purchase price, right? It's the easiest way to work that out for people who are wondering what that is.
Yeah, that's right. And that's hard to replicate. Like a 6.67 is generally what you'll find in a regional property. But if you actually look at the numbers and just if you wash that down to, say, a 6% flat, it's a still really good return. So I never get too fixated on that day one yield, because it's more important what's going to happen over a 10, 20-year period. Because if you're buying a property that will have good rent growth, imagine you get 1% extra each year through growth. All of a sudden, it doesn't matter about that day one yield. It's what's the rent going to be in 10 years' time. And if it's 10% higher, it has a huge impact on your average yield over a 10-year period.
Yeah, and you look at this property here, you're kicking off at 70 grand rent in year one. In year 10, it's at 97 grand, and that's through CPI increases, right?
Yeah.
So the yield each year at that is 9.33%. That's a net yield, 9.33% at that point in time.
Yeah. Yeah. And you could probably, assuming you could sell that off at a 6%, it's a 40% odd difference.
Yeah, good going. All right, Scott, I think we've done well there. So the idea of that was just to unveil where we'd bought, what we'd bought. Be interested to see if any sleuths can work it out. But there's a whole bunch of other stuff that's going on in the background that we need to chat through as part of this, and that's sort of the legal work that's been going on, which is quite onerous.
Yeah. So next steps from here is we've got to sort your property management out. So one of the tips we've got, use a property manager who understands your asset class. There's no point getting someone who only deals with office to manage an industrial or a retail. You want to get specific managers because they'll have the contacts in the right space. Same goes, never use a residential guy to do commercial. I've tried that because I had a really good resi guy and it didn't work out. So back to the professionals. Insurance is something we're normally sorting out at this period, but due to it being strata, there's currently a certificate of currency already in that strata. We've checked, it's valid, so no insurance needed.
Good.
And you're really just getting through to settlement. So that's just like your residential properties. You've got to put all your money in a certain bank account. Your bank's got to then do a PEXA transfer, and away you go. You own the property.
Yep, there you go. And another big part of this is the lending side of it. So I'll do a podcast specifically on that with Scott. We'll get someone in and have a yarn with us about financing this particular asset, which has been reasonably straightforward as you would expect. I've got been through the lending process quite a lot. A little bit more complicated inside a self-managed super fund, but in many ways a lot simpler. So I look forward to sort of running that through with you all and sharing how we sort of went about that and what worked and what didn't work and all those sort of things. But good, Scott. Well, thanks, mate. Thanks to you and your team for sorting this out. I know they've been very patient with me, and I'm sure in those Monday morning meetings they sit there complaining about me not getting back to them and all that sort of stuff. So, but I told you that's the way it was going to be beforehand.
You did warn me, and we're getting there. So
we're getting there.
No
yeah,
stress.
it's funny, right? Because I just go, I know it's important, but I go, the thing is that you do a lot of it. And it's funny, you put it in perspective, some people would be quite jittery about it. I'm just like, yeah, it'll be right. I know when something becomes an issue, and then until it becomes an issue, I just go, yeah, it'll be right. Don't worry about it. Don't worry.
I know what you mean.
Which is frustrating to no doubt to people. But
just before I drove here to see you, my solicitor called and said, you got settlement tomorrow. It's a property I've put under contract 3 months ago.
Yeah.
Just a little development type thing. And so after this, I'm going to the bank and quickly sorting it. So
really,
I'm like you, mate.
You're going to you're paying cash, are you? Is that what you're going to do?
No one's it's a small purchase, so that wouldn't be worth getting the banks involved.
Yeah, okay. Ashtray money. Well, that's Scott O'Neill. Any questions, Scott? And around this, you contact the team over there at Rethink Investing, and I can't remember what the email address is. I'll tell you what it is. It's we actually got feedback to that specific. They went straight to you, I think. info@rethinkinvesting.com.au, and something we'll look at doing over the next few episodes is probably get a sales agent in. So that feedback was great from Jamie, and I'm thinking of doing the 3 stages of commercial investing. So probably get an entry-level investor in, sort of a mid-range like mum and dad, going for their 200K type goal, and then maybe a high net worth guy, so you could see all different angles or client types that we deal with, and just understanding their different goals, and we'll sort of break down the assets we're going through. So I've got to find people willing to talk, and it's a little bit hard. People are quite private in this space, but we've got a couple of people that we can reach out. But if you want to, be one of those, let us know. Sounds good. Info Rethink Investing, go and check it out. You can also find rethinkinvesting.com.au or go and find them on their Facebook. There's always lots of stuff going on there. That's it. That's the commercial purchase that you've been waiting to hear about. I hope we went into enough details for you. There's not much more detail we can go into. Pretty straightforward, but we shared all the ins and outs of that and why it works and what we like about it, and where those sort of red sort of, well, not really red, pink flags are, because they're not bright red. And we're all right across it. So happy to proceed. Hope you enjoyed that. Remember, there's lots of episodes inside commercial property. Just go and search for it wherever you listen to podcasts. We'll see you again next time. Until then, bye-bye.